Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. This is what investor mogul Warren Buffett suggests investors do with their own money, and what he's personally instructed his trustees to do with a chunk of his own portfolio after his passing. And this sentiment has permeated throughout the investment world. Just buy and hold the S&P 500. Well, this sentiment wouldn't be so prevalent if it wasn't for the efficient market hypothesis, or the theory that market prices fully reflect all available information. So in other words, because markets are so competitive and the incentive to make money from the markets is so strong, any new information that affects the future prospects of a company should be quickly reflected in the price of that security, as market participants fight like dogs for quick profits. Historically, riding the train of indexing has been a great bet and has made many people rich regardless of how sophisticated or nuanced their understanding and view of the markets are, which is honestly amazing. I mean, indexing has democratized investing and put power back in the hands of everyday regular people who just need somewhere to grow their money without the pressure of becoming the next Warren Buffett. As much as it's helped the everyday folk, the question still remains: is this theory actually correct? Should you rely on it going forward? Here is a statement that most academics would agree with. Markets are most assuredly not perfectly efficient. I mean, here's why. If markets were perfectly efficient, there would be no profit to be earned by introducing information to the market. This in turn would make the market not efficient and would open up the opportunity for market participants to come back in and take advantage of this discrepancy. So, in other words, without active investing, there is no passive investing. And on the other hand, active investing necessarily relies on some level of market inefficiency. This is what is known as the Grossman-Stiglitz paradox. There needs to be a certain level of active investors that are moving prices to keep the index machine going. This indicates that markets, therefore, cannot be 100% perfectly efficient, though they can still be mostly efficient. Well, that answers the question for this video. Thank you so much for watching. All right, actually, hold on. If the market is efficient, this means that no one group of stocks should systematically and on average beat another group of stocks, right? I mean, after all, if you can predictably rely on a group of stocks beating the rest of the market, then there would be theoretically an arbitrage opportunity openly available to market participants, which should in turn make this anomaly disappear. Well, it turns out that systematically buying cheaper stocks, also called value stocks, has beat the market over the long term on average. This is what Eugene Fama and Kenneth French argue in their 1992 paper, The Cross-Section of Expected Stock Returns. Two easily measured variables, size and book-to-market equity, combine to capture the cross-sectional variation in average stock returns. So is this a blow to the efficient market hypothesis? Well, not exactly. See, the efficient market hypothesis was actually brought to the forefront of academic debate in the 70s by Eugene Fama himself. Yes, the same Eugene Fama who argued that smaller and cheaper stocks can beat the market over the long term. So what's going on here? How can the father of market efficiency possibly claim that a group of stocks can systematically beat another group of stocks? Well, in one word, risk. If assets are priced rationally, our results suggest that stock risks are multidimensional. One dimension of risk is proxied by size, market equity. Another dimension of risk is proxied by book equity to market equity, the ratio of the book value of common equity to its market value. Maybe this makes sense to you. If not, just ask this question: why have stocks consistently outperform bonds over the long term? Well, it turns out that if stocks are inherently riskier than bonds, then they must necessarily offer a higher return than bonds. And you could say the same thing about value stocks versus the market. If there are stocks with some sort of distress, whether they're in less than desirable industries, have poor expectations priced in, or maybe are just going through a rough patch, because the market is efficient, they should theoretically offer above market returns to just hold them. Very well, then the mostly efficient market hypothesis seems to still hold, at least for now. As long as history shows that the assets demonstrating some level of fundamental risk above the market are the ones that have outperformed it, then I think we can all accept the efficient market hypothesis as a pretty rational theory that should guide our investment decision making. But the question is this always the case? There is this one strategy so perplexing that it led Eugene Fama to label it the premier anomaly. When the father of efficient markets says this one strategy is a true anomaly and one that has shown no signs of having been arbitrage, it's important we pay attention. Momentum investing is a simple strategy that buys past winners and sells past losers. That's it. And as simple as the strategy is, it has historically beat the market and value investing. But why? Well, to tell you the truth, I have yet to find any theory that explains why this anomaly has persisted, at least any theory that is based on fundamental risk. Instead, most valid theories assert that there is some behavioral element at work. Okay, but what does this mean for market efficiency and ultimately for your investing strategy? I asked this question to Alpha Architect President Ryan Kirlin. Here's what he had to say.
So when one reviews the academic literature on momentum investing, it's clear that this strategy can only work if the behavioral biases of investors are able to move market prices. With value investing too, there's an argument to be made that investors over-extrapolate the bad news of companies and systematically discount stocks well below fundamental values. So although the market can be highly competitive, it doesn't necessarily mean it's perfectly efficient. There does seem to be some element at play where investor misbehavior can distort market prices over the short term. Factor investors can potentially take advantage of these anomalies by coming up with systematic, rules-based strategies that exploit this misbehavior and hopefully deliver market-beating returns over the long term. All in all, while we believe that markets can be efficient, investor behavior is most certainly not.
Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.